The hidden time bomb. Inside China's real estate empire. For decades, China's rise was presented as unstoppable. Skyscrapers pierced the skyline, entire cities appeared almost overnight, and real estate became the single most powerful engine of economic growth the world had ever seen. To outsiders, China looked like a nation that had cracked the code of rapid development. But beneath the glass towers and megaprojects, a dangerous imbalance was growing. Today, that imbalance has turned into a full-blown real estate collapse, one that the Chinese Communist Party, or CCP, may no longer be able to control. To understand why this crisis is so severe, we must first understand how deeply real estate is woven into China's economy. Unlike many countries, where housing is just one sector among many, real estate in China became the foundation of everything. It drove local government revenue, fueled bank lending, supported household wealth, and even determined social stability. For years, property was not just an investment, it was the investment. Chinese families were encouraged, both directly and indirectly, to pour their life savings into apartments, often buying multiple homes they never planned to live in. The system worked as long as prices kept rising. Developers borrowed heavily, banks issued massive loans, and local governments sold land to generate cash. Everyone benefited, at least on paper. Rising property prices made homeowners feel richer. Developers expanded aggressively, and officials used land sales to fund infrastructure and meet growth targets set by Beijing. But this growth was built on debt, speculation, and unrealistic expectations that prices could only go up. The cracks began to show when China reached a point of oversupply. Entire ghost cities emerged. Vast urban areas filled with empty apartment blocks, dark windows, and silent streets. These weren't abandoned projects. They were completed homes that no one could afford or didn't need. Yet, construction continued. Developers kept building because stopping would expose losses, and local governments kept approving projects because land sales were their primary source of income. The system became trapped in a cycle that required constant expansion just to survive. Then came the turning point. Beijing, alarmed by runaway debt, introduced the so-called Three Red Lines policy to restrict borrowing by property developers. On paper, this looked like a responsible move. In reality, it pulled the rug out from under a system already stretched to its limits. Developers who depended on new loans to pay off old ones suddenly found themselves cut off. Cash flows dried up almost overnight, and the dominoes began to fall. The collapse of Evergrande shocked the world, but it was never just one company. Evergrande was a symbol of a much larger disease. Dozens of major developers were operating on similar models: high leverage, aggressive expansion, and heavy reliance on pre-sales. When buyers lost confidence and sales slowed, these companies couldn't finish projects. Construction halted, workers went unpaid, and millions of buyers were left with unfinished homes despite having already paid their mortgages. This is where the crisis shifted from a financial problem to a social one. In China, home ownership is tied to marriage, family status, and personal security. For many people, buying an apartment represents the achievement of a lifetime. When projects stalled, anger spread rapidly. Home buyers began refusing to pay mortgages on unfinished properties, an unprecedented act in a system built on obedience and compliance. These mortgage boycotts sent a chilling signal. Trust in the system was breaking down. The impact didn't stop with homeowners. Banks, which had massive exposure to real estate loans, suddenly faced rising risks. Local governments, dependent on land sales, saw revenues collapse. Without that income, they struggled to pay debts, fund public services, or continue infrastructure projects. This created a dangerous feedback loop. Falling property prices reduced land values, which hurt government finances, which then weakened the broader economy even further. At the heart of this crisis lies a structural contradiction. China's growth model relied on real estate to drive GDP, but real estate growth requires ever-increasing prices and demand. Once the population began to shrink and urbanization slowed, that model became unsustainable. Fewer young people, rising unemployment, and declining incomes meant fewer buyers. No amount of propaganda could change these demographic and economic realities. The CCP has tried to intervene, as it always does. Interest rates were cut, restrictions were eased, and local governments were encouraged to support developers. State-owned banks were told to lend, and state-owned firms were pushed to take over failing projects. But these measures treat the symptoms, not the disease. Lowering rates doesn't help people who are afraid to buy. Bailouts don't restore confidence in a market where prices are expected to fall. What makes this collapse especially dangerous is the CCP's fear of losing control. Real estate is not just about money, it's about legitimacy. For years, the party justified its rule by delivering economic growth and rising living standards. Now, as property values fall and life savings evaporate, that promise is being questioned. Every unfinished building stands as a concrete reminder of broken trust. Even worse, transparency is almost non-existent. Official data often downplays the severity of the crisis, while independent reporting is censored. This creates an information vacuum where rumors spread faster than facts. In such an environment, panic can escalate quickly, and once confidence is gone, it is incredibly hard to rebuild. China's real estate collapse is not a temporary slowdown or a normal market correction. It is the result of decades of distorted incentives, political pressure, and debt-fueled growth. The foundations were weak, even as the buildings rose higher and higher. Now, those foundations are cracking, and the entire structure is at risk. How China's property crash is poisoning banks, local governments, and the financial. As China's real estate sector unravels, the damage is spreading far beyond unfinished apartment blocks and angry homebuyers. What began as a property slowdown has evolved into a systemic financial threat, one that strikes at the very core of China's economic model. Banks, local governments, and shadow lenders are now trapped in a web of bad debt, declining revenues, and vanishing confidence. This is the stage where a housing crisis transforms into a national financial reckoning. China's banking system is deeply exposed to real estate in ways that are often underestimated. On the surface, official figures suggest that banks are well capitalized and stable. But look closer, and a different picture emerges. Mortgages, developer loans, and land-backed financing dominate balance sheets across the country. When property prices were rising, these loans looked safe. Apartments were seen as guaranteed collateral, and land values were assumed to only increase. That assumption is now collapsing. Mortgage stress is one of the most dangerous pressure points. Millions of Chinese households took out long-term mortgages on homes that were never completed. As construction stalled, trust evaporated. The mortgage boycotts that followed were unprecedented in scale and symbolism. For banks, this was a nightmare scenario. Mortgages are supposed to be the safest loans in the system. And when borrowers stop paying, not because they can't, but because they refuse, the entire risk model breaks down. At the same time, developers began defaulting on massive loans. Once sales slowed, cash flow vanished, and debt repayments became impossible. Banks tried to extend maturities or restructure loans, but this only delayed recognition of losses. Non-performing loans rose quietly, often hidden through accounting tricks or rolled into new credit vehicles. The problem wasn't solved, it was buried. Then there are China's local governments, which may be the weakest link of all. Unlike central governments, local authorities in China rely heavily on land sales to fund operations. For years, selling land to developers generated enormous revenue, allowing cities and provinces to build roads, subways, and industrial parks. When property developers collapsed, land auctions failed. Revenues plunged almost overnight. To survive, local governments turned to a complex network of financing vehicles known as local government financing vehicles, or LGFVs. These entities borrowed heavily, using land as collateral, to fund projects and meet growth targets. But as land prices fall, the value backing these loans is shrinking. LGFVs are now sitting on trillions of dollars in debt, much of it with unclear repayment sources. In many regions, governments are borrowing just to pay interest on existing loans, a classic debt spiral. The risk here is not just default, but contagion. Banks, trust companies, and insurance firms all hold LGFV debt. If these vehicles begin to fail, losses will spread across the financial system. Unlike a single corporate bankruptcy, this would strike at public institutions themselves. The line between state and market, already blurred in China, would become dangerously unstable. Shadow banking adds another layer of complexity. For years, wealth management products were sold to ordinary citizens as safe, high-yield investments. These products often funneled money into real estate projects or local government debt, promising returns that traditional banks could not offer. Many investors believed these products were implicitly guaranteed by the state. Now, as projects fail, those guarantees are being tested. When wealth management products stop paying out, public anger rises quickly. These investors are not wealthy elites. They are middle-class families, retirees, and small business owners. Losses here directly hit household confidence and consumption. People who feel cheated do not spend, they save or protest. Either outcome slows the economy further. The CCP faces a brutal dilemma. If it allows widespread defaults, confidence in the financial system could collapse. If it bails everyone out, debt will explode to unsustainable levels. Every intervention creates new risks. Supporting developers angers households who already paid for unfinished homes. Supporting banks protects institutions, but does little to revive demand. Supporting local governments keeps cities running, but delays painful reforms. What makes this crisis especially difficult to manage is the lack of transparency. Bad loans are often hidden, reclassified, or pushed into off-balance sheet entities. Official statistics rarely capture the full scale of the problem. This creates a dangerous illusion of stability. Investors, both domestic and foreign, know that the real numbers are worse than reported. As a result, trust continues to erode, even when markets appear calm. Foreign investors are already reacting. Capital is quietly leaving China, not in dramatic crashes, but in steady outflows. International funds are reducing exposure to Chinese banks and property-linked assets. This capital flight puts pressure on the currency and limits Beijing's policy options. Defending the yuan requires reserves, while stimulating the economy requires spending. Doing both at once is increasingly difficult. Meanwhile, ordinary Chinese citizens are changing their behavior. Property was once seen as a safe store of value. Now it is viewed as a trap. Young people are delaying home purchases, marriage, and even having children. This demographic shift feeds back into the property crisis, reducing future demand even further. What was once a growth engine has become a drag on the entire system. The CCP still claims it has the tools to manage the fallout, pointing to state-owned banks and centralized control. But control does not equal confidence. You can force banks to lend, but you cannot force people to buy homes they believe will lose value. You can silence critics, but you cannot erase unpaid debts or empty buildings. China's financial system was built on the assumption that real estate would always support growth. That assumption is now broken. Banks are exposed, local governments are drowning in debt, and households are losing faith. The longer this crisis drags on, the more it resembles a slow-motion financial implosion rather than a manageable downturn. Why the CCP's rescue plans are failing and control can't fix a broken market. As China's real estate crisis deepens, Beijing has rolled out rescue plan after rescue plan, insisting that stability can be restored through control, coordination, and state power. On paper, the Chinese Communist Party appears uniquely positioned to manage economic shocks. It controls the banks, influences the courts, directs the media, and commands local governments. Yet despite all this power, the property collapse continues to worsen. The reason is simple but uncomfortable. Political control cannot reverse economic reality. The CCP's first instinct was to calm the market through policy easing. Mortgage rates were lowered, down payment requirements were reduced, and restrictions on home purchases were relaxed in many cities. In the past, such measures would have sparked a buying frenzy. This time, the response was muted. People didn't rush back into the market. Instead, they hesitated. Lower rates, done in T matter when buyers believe prices will fall further or fear that developers want to T-finish projects. This exposes a critical shift in psychology. For years, Chinese consumers believed property prices were guaranteed to rise because the state would never allow a crash. That belief has now been shattered. Once confidence is lost, it cannot be ordered back by decree. Markets run on expectations, not commands, and expectations across China have turned pessimistic. Beijing also pushed state-owned enterprises to step in and rescue failing developers. In theory, this would ensure projects were completed and restore trust. In practice, it created new problems. State firms took over some projects, but not all. They prioritized developments in major cities while abandoning smaller, less profitable ones. Millions of buyers in lower-tier cities were left in limbo, watching cranes rust and buildings decay. Even when projects resumed, the damage to trust was already done. Homebuyers realized that completion was not guaranteed, and even finished apartments could lose value. The message was clear. The state would intervene selectively, not universally. This selective rescue undermined the very confidence it was meant to restore. Another major policy move was pressure on banks to increase lending. State-owned banks were instructed to support developers, local governments, and key projects. But banks face their own constraints. They are already loaded with risky loans tied to real estate. Forcing them to lend more increases long-term instability. Many banks complied on the surface while quietly tightening conditions or redirecting funds to safer borrowers. The result was more headlines, but little real relief. The CCP also leaned heavily on propaganda. State media emphasized stability, long-term fundamentals, and temporary adjustments. Critical reporting was censored, and discussions of worst-case scenarios were shut down. While this may reduce panic in the short term, it creates a dangerous information gap. When people sense that reality doesn't match the official narrative, they trust neither. Silence becomes a warning sign, not reassurance. Perhaps the most revealing failure lies in the handling of local governments. Beijing encouraged them to buy unsold housing stock, convert it into social housing, or support developers directly. But many local governments are already drowning in debt. Asking them to absorb more liabilities is like asking a sinking ship to carry extra cargo. In some cases, these purchases were funded with new borrowing, pushing financial stress further into the future rather than resolving it. Political constraints make genuine reform even harder. A real solution would require accepting lower growth, allowing widespread bankruptcies, and restructuring debt transparently. But such steps risk unemployment, public anger, and challenges to party authority. The CCP has built its legitimacy on economic performance. Admitting failure in the property sector threatens that foundation. There is also a deeper structural issue the CCP cannot easily fix: demographics. China's population is aging rapidly, and the number of young people entering the workforce is shrinking. Fewer young families mean fewer first-time homebuyers. Urbanization, once a powerful driver of housing demand, is slowing. These trends are irreversible in the short to medium term. No stimulus package can create buyers who don't exist. At the same time, youth unemployment remains high, even if official data is obscured or paused. Young people without stable jobs cannot afford homes, nor do they want to take on decades of debt in an uncertain economy. Many are choosing to lie flat, rejecting the traditional path of career, marriage, and home ownership. This cultural shift directly undermines the property market's future. The CCP's governance model further complicates matters. Decision-making is centralized, but implementation depends on local officials who are often incentivized to hide problems rather than report them. Bad news travels slowly upward, while optimistic reports move quickly. This creates policy delays and miscalculations. By the time corrective action is taken, conditions may have already deteriorated. International pressure adds another layer of strain. Trade tensions, technology restrictions, and geopolitical rivalry limit China's external growth options. In the past, exports could help offset domestic slowdowns. Today, that safety valve is narrower. As foreign companies diversify supply chains away from China, job creation slows, reducing income growth and further weakening housing demand. The most dangerous misconception within the CCP may be the belief that time alone will heal the market. Officials often frame the crisis as a cyclical downturn rather than a structural collapse. But this is not a normal cycle. It is the unwinding of a decades-long model built on debt, speculation, and political incentives. Waiting does not solve such problems. It magnifies them. Control can delay consequences, but it cannot eliminate them. The CCP can instruct banks to roll over loans, silence dissent, and manage appearances. What it cannot do is force millions of people to believe again in a market that has betrayed them. Confidence, once broken, is painfully slow to rebuild. As rescue plans lose effectiveness and trust continues to erode, China AS real estate crisis is evolving into something far more serious. A test of the CCP's ability to govern in an era of slowing growth and rising expectations. In the final part, we will explore what comes next, whether China faces a long economic stagnation, a sudden shock, or a historic turning point that reshapes its future and the global economy. What comes next? Why China may face a lost decade and the world can't ignore it. China's real estate collapse has now moved beyond denial, rescue plans, and temporary fixes. The question is no longer whether the crisis is real, but what kind of future it will create. History shows that property crashes rarely end cleanly. They either trigger a sharp reset or drag economies into long periods of stagnation. For China, the signs increasingly point toward the second outcome, a slow, grinding adjustment that could reshape the country for an entire generation. One possible path is a lost decade, similar to what Japan experienced after its property bubble burst in the 1990s. Like China today, Japan once believed its growth model was invincible. When the bubble collapsed, asset prices fell, debt lingered, and confidence never fully recovered. China shares many of the same warning signs: aging demographics, high debt, weak consumption, and a property sector that can no longer drive growth. The difference is scale. China's economy is larger, more complex, and more deeply intertwined with global markets. In a prolonged slowdown, property prices may continue falling slowly rather than crashing all at once. This is politically easier for the CCP to manage, but economically damaging. Falling prices discourage buyers, while existing owners feel poor and spend less. Developers remain cautious. Banks stay defensive and investment slows. Growth does not collapse. It fades. Over time, this erosion can be just as destructive as a sudden crisis. Another risk is a sudden shock triggered by a loss of confidence. This could come from a major local government default, a large bank failure, or a sharp currency move. Because transparency is limited, markets often react violently when bad news finally breaks through. If investors suddenly believe the state can no longer guarantee stability, capital outflows could accelerate rapidly. The CCP fears this scenario most, which is why it prioritizes control over openness. The social consequences may be even more serious than the financial ones. For decades, China's social contract was simple: accept political control in exchange for rising living standards. Real estate played a central role in that promise. Homes were savings accounts, retirement plans, and symbols of progress. As prices fall and projects remain unfinished, that promise looks increasingly hollow. Young people are already responding. Many no longer believe that hard work will lead to security. Delayed marriages, lower birth rates, and declining ambition are not just cultural trends. They are economic signals. A society that stops believing in the future becomes harder to govern, even with strict control. Stability enforced by force is fragile when hope disappears. The CCP still has options, but none are easy. It can push through painful reforms,